One key factor in all of this is the money supply. In 2020, fear over a pandemic shutdown prompted the Federal Reserve to begin pumping more than $6 trillion into the U.S. economy to combat unemployment and promote economic growth. Congress injected close to another $6 trillion in stimulus-related spending. The result? An overstimulated economy.
The reason we have such high inflation now is that the money supply was growing so fast in 2020 and 2021. That's still in the system. That's still driving things.
Steve Hanke served on President Reagan's Council of Economic Advisors and is now a professor of applied economics at Johns Hopkins University. He says the Federal Reserve got this one wrong.
They're overdoing things, you see. They created this huge growth in the money supply in 2020 and 2021. That, with a lag of 12 to 24 months, gave us a lot of inflation. That's still in the system. And now they hit the panic button early last year, and they're overdoing it. They're squeezing the money supply too rapidly, and it's actually contracting in an unprecedented way.
As the Fed rapidly raises interest rates, many businesses are hurting, and much less money is going into the economy. Hanke says it's now just a matter of watching the recession play out.
The money supply starts changing, in this case, actually going negative on us. With a lag of about 1 to 9 months, asset prices react. They go down. That's why the stock market's been kind of stagnant. Nothing going on in the stock market. Then, with a lag of about 6 to 18 months, the economy reacts. Real economic activity starts changing. And that's the recession. That is the recession.
Hanke anticipates recession to begin around the end of this year and predicts inflation will continue throughout it. In the meantime, he's largely ignoring economic headlines like job reports, the dollar status, stock market, and unemployment numbers, and simply watching the money supply.
Money dominates. That's the signal. The rest of the data are important. They're not irrelevant, but they can be, and they usually are noise because people really can't package them into any meaningful model that leads to an accurate prediction.
While Hanke can't predict the length of a recession, he believes it will be significantly worse if the Fed keeps raising interest rates. He recommends a pivot that would allow smaller economic growth rather than continuing to seek contraction. Caitlin Burke, CBN News, Washington.
Well, the Fed has already indicated they're going to continue to seek contraction. They're trying to get wage inflation under control. And until they start seeing changes in the labor market, they're not going to let up on raising interest rates. Now, what does this mean for you and me? It means that we're going to be paying higher interest on credit cards. We're going to be paying higher interest on home mortgages. So whatever you can do to get out of credit card debt, please do. Those rates are going to go up, and they're going to go up significantly because of what the Federal Reserve is doing. So as a consumer, rein it back in. The problem with that advice is when we rein it back in, the recession starts to get worse. So for those looking at retirement funds, those have been stagnant. They took a big drop last year. Will they take another drop this year? I don't know. But I do know there are some safe havens. Like, I've never recommended money markets to people, but at least you're going to get 4% on your money, and you're not going to be taking any kind of risk for further stock market declines. Some are, advising to go into some kind of hard assets, those kinds of things. I view that as speculation. So if you want to stay safe, keep your money in a money market. Here's, to get really geeky with this, here's a macroeconomic view. The total GDP, the gross domestic product of the United States, is 23 million. During the pandemic, the Federal Reserve pumped another $6 trillion into that market, and then Congress came along and had another $6 trillion in stimulus packages. So you added half the gross domestic product of the United States into an economy to keep it floating while we're in the middle of a pandemic, and that caused this inflationary spiral. You can look at supply chain, you can blame that, you can blame big energy, all of that as a political move. And when you add 12 trillion to an economy and there are no strings attached, watch out, there will be inflation.